Hello everyone, and welcome back to the channel. If you're holding shares in Procter Gamble or are considering it, you'll want to pay close attention. The consumer staples giant just dropped its earnings, and we've got the full breakdown. On the surface, it's a story of a reliable titan doing what it does best, beating expectations and printing cash. But dig a little deeper, and you see a company navigating a very tricky consumer landscape. So let's get into the numbers and see what's really going on with PG. The Procter & Gamble Company is a globally recognized American multinational consumer goods corporation headquartered in Cincinnati, Ohio, renowned for its extensive portfolio of trusted and market-leading brands. Founded in 1837, it has grown into one of the world's largest and most influential companies in its sector, operating in key product categories including fabric and home care, baby and feminine care, family care, beauty, grooming, and health and wellness. With a powerful brand portfolio that includes household names such as Tide, Pampers, Ariel, Gillette, Oral-B, Pantene, and Crest, P&G markets its products to consumers in over 180 countries. The company's success is driven by its strong commitment to innovation, consumer-centric research and development, and a sophisticated marketing strategy that builds deep brand loyalty, generating annual sales in the tens of billions of dollars and making it a cornerstone of the global fast-moving consumer goods industry.
First, the headline numbers that got the market excited. Net sales came in at $22.4 billion, up 3% year over year, and slightly ahead of the $22.2 billion analysts were expecting. Where it really impressed was on the bottom line. Core EPS was $1.99, a solid 3% increase and a clear beat over the $1.90 estimate. And in a standout figure, net earnings jumped 20% to $4.75 billion. The market loved this, sending shares up about 4% in pre-market trading. A beat is a beat, right? But the real story is in the details. Because when we look at the performance by segment, we see a tale of two consumers. On the strong side, we have the premium categories. Beauty led the charge with an impressive 6% organic growth, driven by high-end brands like SKI2 and its hair care lines. Grooming also grew 3%, thanks to premium razor launches and partnerships. But on the other side, the core household essentials had a much tougher quarter. Fabric and home care was flat, with weaker demand for laundry detergents in the US and Europe. Baby, feminine, and family care was also flat, as CEO John Moeller noted that value-seeking consumers are buying smaller sizes or switching to private labels. This perfectly illustrates the bifurcated consumer behavior we keep hearing about. Now, this was a significant quarter for leadership, as it's one of the last for outgoing CEO John Moeller. He framed these results as strong execution in a challenging geopolitical and consumer landscape. And he backed that up with some staggering stats. This marks P&G's 40th consecutive quarter of organic sales growth and 10 straight years of EPS growth. He highlighted the company's three-part strategy to navigate this environment: superiority in their products and branding, productivity and strict cost control, and increased innovation to make consumers feel the value of their products is worth the price. He also noted some relief on the cost front, with lower logistics costs and some tariff relief from Canada. So what does this mean for shareholders? The answer is a lot of cash. P&G's cash machine is still humming. They generated a massive $5.4 billion in operating cash flow and returned $3.8 billion to shareholders via dividends and buybacks just in this quarter. Their free cash flow productivity was an exceptional 102%. Looking ahead for the full 2026 fiscal year, they plan to return a staggering $15 billion to shareholders, about $10 billion in dividends and $5 billion in buybacks. Let's also look at the not-so-good news.
P&G is facing a perfect storm of consumer and macroeconomic challenges. First, and most importantly, is the slowing volume growth. Despite raising prices, the actual number of units sold is flat. Why? Because inflation-weary shoppers are finally pushing back. They're trading down to private label brands or simply buying smaller sizes to save money. The company's own CFO, Andre Schulten, has warned that this value-seeking behavior in Western markets could persist through 2026. Second, margins are getting squeezed. While the worst of the tariff impacts are behind them, commodity, transport, and packaging costs are still eating into profits. In their last quarter, gross margin fell by 50 basis points. And let's not forget, P&G spends a massive 13% of sales on marketing and innovation to defend its brands. That's essential, but it limits their ability to boost profits in the short term. Third, the company is undergoing a major restructuring. This isn't just a minor adjustment. We're talking about 7,000 job cuts and a streamlining of lower-margin international brands. While this could make them more efficient in the long run, near-term transition costs and operational disruption are a real risk. And this brings us to the fourth point, valuation. Many analysts argue that P&G's stock is already fully valued, if not overvalued. With a PE ratio around 25x, it's priced for perfection. Morningstar, for instance, places its fair value estimate at $147, significantly below the current price near $166. Given the company's own mid-single-digit earnings guidance, there's limited visible upside from here.
So, with all those challenges, why is P&G still a core holding for so many? Because the bull case is built on a foundation of incredible strengths. Number 1, unmatched strength in premium segments. While shoppers might be cutting back on basics, they're still splurging on P&G's high-margin beauty, grooming, and healthcare products. Innovations like SK2 Regenis in skincare and the Gillette Labs Carbon Razor are proving that strong brands can still command pricing power even in a tough economy. Number 2, the cost pressures are easing. The company itself projects it can recapture 50 to 70 basis points of margin in FY 2026 thanks to lower tariff impacts and falling ocean freight rates. This is a key tailwind to watch. Number 3, a massive digital transformation. P&G isn't just a soap company anymore. It's becoming a tech-driven operation. Their integrated strategy leans heavily on AI for retail analytics, automated logistics, and demand forecasting. Once fully scaled, this could unlock over $1.2 billion in annual cost savings. And finally, the cornerstone of the investment thesis, shareholder returns. P&G is a dividend aristocrat, a status it protects fiercely. In FY 2026 alone, it's expected to return a combined $15 billion to shareholders through dividends and buybacks. For investors seeking stability and reliable income in a volatile market, that defensive yield premium is incredibly attractive. Let's look at the raw numbers that make dividend investors so confident. Current dividend. They pay an annual dividend of $4.23 per share, which breaks down to about $1.06 every quarter. Current yield, that gives them a dividend yield right around 2.7 to 2.8%. Not the highest on the market, but that's not the point here. The point is safety and growth. And the King's record and what growth it has been. P&G is a certified dividend king, having raised its dividend for 68 to 69 consecutive years. Think about that. They've been increasing their payout through recessions, bear markets, and massive economic shifts since the 1950s.
To put that growth into perspective, a decade ago, in 2015, the quarterly dividend was just 56 cents. Today, it's $1.06. That's a 90% increase in your quarterly income if you held the stock over that period. So the history is rock solid. But what about today? Is the current dividend safe? This is where P&G truly shines. Let's look at 3 key pillars of safety. 1. The payout ratio. The company pays out about 64–65% of its earnings as dividends. While this is slightly above the ideal 60% benchmark, it's far from alarming. More importantly, when you look at their immense cash flow, the picture gets even better. The dividend only consumes about 50% of their operating cash flow, which is considered excellent coverage. 2. Cash is king. P&G is a cash-generating machine. They produce a massive $17 to $18 billion in annual free cash flow. Their total dividend bill, roughly $11 billion. This means their cash flow comfortably covers the dividend with billions to spare for reinvestment and buybacks. 3. Fortress balance sheet. They have an incredibly strong financial position. Key ratios like a net debt to EBITDA below 2x and an interest coverage ratio over 25x mean they have ample liquidity and virtually no risk of being unable to pay their obligations, including those dividends. In fact, one independent analyst service gives P&G's dividend a safety score of 0.99 out of 1.00, signaling virtually no risk of a cut. It doesn't get much safer than that. The overall analyst consensus for Procter & Gamble is a moderate buy. This isn't a screaming, must-buy right now rating, but a confident, steady vote of support. Digging into the numbers from over 20 major firms, roughly half are in the buy or strong buy camp. Another 40 to 45% recommend a hold, and less than 10% are suggesting you sell.
So the sentiment is broadly positive, but where do they see the stock going? The average 12-month price target sits between $175 and $177 per share. With the stock currently trading around $156, that implies a potential upside of about 11 to 13% from here. Not a moonshot, but a very respectable return, especially when you add in that reliable dividend. Now, not all analysts see it exactly the same way. Let's look at some of the key players. Firms like Raymond James and RBC Capital Markets are bullish, with outperform ratings and targets around $175 to $177. They point to Procter & Gamble's incredible pricing power and strong supply chain efficiency as key advantages. UBS is also positive with a buy rating, though they recently trimmed their target slightly, citing concerns about slower volume growth. On the more cautious side, JP Morgan has a neutral rating. They feel the stock is already fully priced and aren't expecting a surge in sales volume. And then there's the standout bull, D.A. Davidson. They have a sky-high price target of $209. Their thesis hinges on the massive potential they see in P&G's premium beauty and razor brands. The bulls love P&G for its resilience. Even in a tough economy, people still buy Tide detergent and Crest toothpaste. This gives P&G incredible pricing power. Combined with their innovation pipeline and that legendary dependable dividend, it's seen as a fortress. The bears, however, point to one major weakness: flat volume growth. As prices have gone up, some consumers are trading down to cheaper value brands. This is why most analysts only see earnings growing at a modest 5% or so per year. There's a ceiling on how high the stock can fly if it's not selling more units. Procter & Gamble is universally viewed as a steady compounder, not a high-growth story. It's the definition of a defensive core holding for a long-term, income-focused portfolio. Procter & Gamble remains a defensive fortress and a dividend aristocrat for a reason. It's navigating challenges better than most. What do you think? Is P&G a must-hold in your portfolio, or are you worried about the flat volumes? Let me know in the comments below.